Will the market go up or down? Should you lock in or float? Find out this and more with Master of the Markets, hosted by Barry Habib of MBS Highway. Brought to you by United Wholesale Mortgage.
Does your wholesale lender do this for you? Free customizable marketing materials, online loan tracking for your clients, returns your past clients to you, and complimentary client retention campaigns. Don't you think it's about time you found one that does? Partner with United Wholesale Mortgage and receive these benefits and more.
Hi, I'm Barry Habib at MBS Highway, and welcome to another edition of Master of the Markets. This is created exclusively for Mortgage News Network. I've got to tell you, it was another crazy week last week, especially when you look at the activity in the stock market. Now, we did make this call during the week to our subscribers saying it would be an exciting day, especially when the sea change came where the S&P broke beneath its 200-day moving average. I want to show you a close-up of that, and the implications could be quite great because a lot of times cash flows out of the stock market and into the bond market. We really didn't see much of a reaction there, and this week will be a very pivotal one as we will see if the stock market decline continues and if that can push mortgage rates to better levels, push bond prices to better levels, and help mortgage rates decline a little bit. Now, in addition to that, there was quite a bit of housing news that we received this week. It was very, very favorable. We did get existing home sales, really good number, very strong all along for the past several years, although the media keeps on trying to bang the drum on how bad it is. The fact of the matter is that the conditions are exceptionally good. It's almost like a Goldilocks condition. Not too hot, not too cold, just right, so to speak, in the housing industry, at least for now. The forecast for the next few years is quite positive. So let's break down some of the numbers. We did get housing starts, and housing starts came in about as good as it's been for the past 10 years. However, the media is still yearning for the old days when we got housing starts near 2 million or above 2 million. It came in at 1.2 million. I want to show you a chart here, and let's just kind of put this in perspective. Yeah, the media wants 2 million housing starts again, but when we had that, that was right before the housing bubble, 2006, 2007. As you could see, the big drop in housing starts adjusted the amount of supply that was out there. The media just doesn't understand the relationship between supply and demand. It's economics 101. And when you have strong demand and limited supply, prices are supported. Here you had enormous supply, and as soon as demand slowed down because of situations that changed in the financial industry, well, you saw prices decline quite rapidly. So here we are, steady increase, far from bubble-like conditions. I think we have a lot of legs to go in this particular run. Now, when we take a look at this, we see that currently 5 to 6% appreciation is about where much of the country has been. In fact, the forecast is for that to continue for years down the road. And the question is it sustainable? Well, if you listen to the media, they'll tell you it's not sustainable. They say, no, incomes aren't keeping up with appreciation. Incomes are rising 2%, appreciation is going up by 5%, and you hear it all over. But you don't compare home price to income. In fact, it's home payment, isn't it? Because when you think about home payment compared to home price could actually go down, but if interest rates shot up, then that home becomes less affordable, doesn't it? So it's really a combination of things. It's what is your income, it's what is your down payment, what is the home price, and what is the interest rate, what is the cost to borrow. All of these factors come into play into something called home affordability. And home affordability levels in much of the country are at their best levels that they've ever been right now. That's right, even after we've seen prices go up. That's because incomes have risen. So let's get back to this thing about if incomes are only rising by 2 or 2.3% and home prices are appreciating by 5 or 6, is that sustainable? Let's break it down for you and let's take a look. Let's remember now that the average front ratio is 20. Now, when you take a look at this number from Fannie Mae, they say their average on a mortgage, the front ratio is 20. I know you can qualify for much higher, but it's not important what the front ratio is. What is important is the relationship between the two. And 5% appreciation, as you could see here, if you take the median home price today and you stretch that out 5 years from now, you're over $300,000. This is, $64,000, $65,000 worth of appreciation that you would see in 5 years with just 5% appreciation. So is that sustainable? As I said earlier, there's this relationship of about 5 to 1, or 20% of your income is typically what your mortgage payment is. So if your mortgage payment's $1,000 a month, your income's $5,000 a month. That's your roughly 20% relationship between the two. So if your home payment went up by 5%, so let's assume interest rates for a moment stay the same, but that home went up 5%. Well, that would mean that the payment would go up $1,000 to $1,050 from $1,000. Does your income have to go up 5% to match that increase of $50? It doesn't. Your income only needs to go up 1%. So if interest rates remain stable, a 2% rise in income could sustain an annual increase of 10% in appreciation. Now, that would probably be a little bit of a hot market if that continued, maybe getting too hot, but certainly 5% like we've seen is a very sustainable level so long as incomes keep up between this 2 and 3% annual range. And remember, this is median income. When you talk about people purchasing a home, they tend to be at the higher level of the income scale, and their incomes are rising at a faster pace than this 2.3%. So this is a very conservative number, and it's a very good one. Now, we've talked about this in the past. It's just something else I want to bring up because it came up today, establishing that the median age for a first-time home buyer is 33. And I think this chart's very telling. Here's your baby boomer generation and the births that occurred for baby boomers. The millennials now, although they have had a little bit less as far as births go, they have become the largest population segment in the United States. They just eclipsed baby boomers because not all the baby boomers are still around as they've aged. Now, as far as millennials go, when you take a look at millennials, the average age for a first-time home buyer being 33, that's right here in the millennial chart. We are in for a big wave up in millennials that will be looking to purchase homes over the next decade. So this is just one dynamic. It's just one factor. There's a lot of factors, but this one here, the dynamic as far as first-time home buyers, that's a very good one into the future for the housing market. And if you take a look, one of the things that we look back and we say, okay, when we looked in 2006, 33-year-olds, that really dropped. And this period corresponds exactly with the housing bubble. Lots of supply like we showed you, very little, well, I should say very little, but a big drop-off in the demand side and people buying. So all important information for us to contemplate and consider. I do want to show you the stock market chart really quick before we go. And first of all, here's mortgage bonds. All this decline in the stock market should have resulted in mortgage bonds having a better rally. Yes, they rallied, but they can't get over this blue line, this 200-day moving average. It's a very important ceiling, and this is what's got me a little bit worried. If we break above this, man, we could see some really good rates, and the key will be the stock market. Let's take a look at the S&P 500 before we close. And you could see this enormous drop-off, fell off a cliff. But when did that all happen? When we broke beneath. I want to take a little bit of a longer look with you. Beneath this blue line, that 200-day moving average. It's a very important indicator. Look how it's acted as a floor. As soon as we broke that floor, man, it was look out below like a trap door open. Same thing happened about a year ago when we broke beneath that 200-day moving average, dropped way down, but then eventually rebounded. Now, this is another floor here, dipped beneath it. We'll have to watch carefully. If stocks can rebound around this level, 1978 on the S&P, and break above it, we could see stocks rally and bonds have a little bit more of a tough time. But if we continue to see a decline in the stock market, could drop down to 1941 or 1895 on the S&P, that should give interest rates a nice move lower, bond prices a nice move higher. Hey, hope you guys have a great day. Subscribe for free. We put this stuff out every single day. Click the link, subscribe for free, and why not get this every day and have these talking points with your customers. Have a great day. Bye-bye.
Today's Master the Markets was brought to you by United Wholesale Mortgage.
This is Mortgage News Network.